Over the last few years, commercial property insurance has been one of the most challenging lines to place. Capacity restrictions, rising reinsurance costs, and double-digit premium increases are what the common story was. But as we head now into 2026, the data is telling a very different story. So what's the big picture? We're seeing strong indicators that commercial property insurance rates are continuing to soften, and in many cases, materially so, driven by increased competition, excess capacity, and improved reinsurance conditions. What is the market saying? Well, if we listen and look at what the big brokers are saying, let's start with Hub International. According to Hub, they're seeing greater competition and excess capacity are expected to continue pushing commercial property rates down by as much as 15% in 2026, following similar decreases in late 2025. Residential property rates could fall even further, up to 25%, largely due to new underwriters entering the market. For insureds with strong loss prevention, clean loss history, and minimal catastrophe exposure, we're seeing rate reductions up to 50%. That's right, 50%, depending on geography and historical performance, of course. Even cat-exposed risks, which have been under pressure for years, are expected to see relief down 10 to 20%, particularly for accounts that absorb significant increases in prior renewals. If we shift over to another broker, USI Insurance Services, they recently forecasted that property markets could be down as much as 20% overall, while casualty markets are going to remain flat to slightly positive. But we'll address that another time. Here's how USI breaks it down. Non-cat exposed favorable risks, flat to down 10%. Cat exposed favorable, down 5 to 20, and unfavorable loss history or risk profile, anywhere from down 15 to up 5. But overall, you're seeing downward pressure on rates. And what are we seeing from the broader market? Well, the Council of Insurance Agents and Brokers reinforced this in their Q3 Property and Casualty Market Survey, noting that commercial property premiums declined for the first time since Q2 2017, with an average decrease of 0.2%. Sounds small, but we're starting to see that crest in rates, and we're starting to see the downward trend from CIAB. They attributed this shift to two changes: increased property capacity and a softened reinsurance market. More than half of the survey respondents reported increased carrier capacity driven by new carriers and MGAs entering the market, and others re-entering the market that had exited during the 2023 hard market. So what's the catalyst for this lower pricing? What's the overarching theme? Reinsurance. We saw Business Insurance come out the other day saying that January 1st reinsurance renewals were down 10 to 20% as abundant capital outpaced demand. That matters because when reinsurance costs come down, primary carriers gain flexibility, and that relief gets passed down onto the insureds. So looking ahead to the rest of 2026, the key takeaway is this: market conditions are improving, but outcomes are highly risk specific. Organizations that invest in loss control, tell their story well, and proactively manage their risk profile are best positioned to benefit from this cycle. If you're heading into an upcoming renewal early in 2026, or just want a second opinion on whether your program is positioned correctly, now is the time to take a proactive look. Let's talk.